So businesses often will need to get short-term funding to meet working capital requirements. And so something that's issued sometimes is called a note. You usually go get that from your bank, or you can get it from private individuals. And a note is basically a short-term loan. In this case, a company on January 1st, 2019, the company borrowed 40,000, so 40,000 on a 1-year note. So what's the journal entry for that? Well, we start with a debit of to cash of 40,000. And then we're going to have a credit. So we got the cash. So we always start with things we can touch. We got the cash, so 40,000. You can put a $sign here if you like. And then we have a credit, which means it's going to be over just a little bit, and we're going to call it a note. Or you could call it note payable. And you'd put it on there for 40,000 also. And debits equal credits. So our debit equals our debit right here equals our credit right here. And so everything's in line. And how this impacts the balance sheet is we have cash would be increasing. This is where this debit actually impacts the balance sheet. So it's a debit to cash, and it's increasing by 40K. I got over the line just a little bit, but you get what I'm doing. Cash for 40K. And this credit is a liability right here. And so the credit goes to a notes payable for 40K. And you'll notice everything's in balance because of this equal sign. Assets equals liabilities plus equity, right here, owner's equity. We increased our assets, and at the same time, we increased our liabilities by the same amount. So this equation will balance. Everything's going to be in balance. We have one debit and one credit, which is, and so everything's in line here. This is how you do the journal entry.